If you're hunting for the true alpha in this current AI cycle, honestly, you gotta look right past the AI agents themselves. From a macro investment perspective, the enduring value, the real structural story here, is all about the infrastructure being built right now to allow machines to actually transact and set our economic systems at scale. We're talking payment rails, identity frameworks, and settlement architecture. Welcome to this explainer. Today, we're mapping out the machine economy stack to figure out where the smart money is actually heading. Here's a quick look at our agenda. First, beyond the AI agent. Second, the machine economy stack. Third, programmable delegated authority. Fourth, the incumbent structural advantage. Fifth, stablecoins and API commerce. And finally, number 6, the emerging attack surface. All right, section 1, beyond the AI agent. Right now, the whole market is obsessing over intelligence, right? Models, productivity tools, workflow automation. But here's the thing. Intelligence itself is rapidly commoditizing. The real economic moat of the next cycle isn't autonomous intelligence. It's the infrastructure of machine commerce. Economic gravity is decisively shifting toward the payment rails, identity frameworks, and compliance architectures that are literally being re-engineered from the ground up for a totally new class of non-human economic actors. To really grasp this, we need to define the absolute foundational concept of this new era, and that is programmable delegated authority. Basically, this is the bounded economic power that we grant to machines so they can access payments and execute transactions inside controlled environments. I mean, we're not talking about just handing an AI a blank check and crossing our fingers it doesn't max it out buying a yacht, right? We are talking about strictly bounded economic power. These digital machine wallets are rapidly evolving into the literal operating systems for programmatic economic activity. Moving on to section 2, the machine economy stack. To really analyze where value, constraints, and pricing power are going to concentrate, we use this structural framework. Starting down at layer 1, you've got physical inputs. Then moving up, layer 2 is energy and compute. Layer 3 is perception. Layer 4 is logic and orchestration. And finally, all the way at the top is layer 5, identity, settlement, and liability. Notice how economic gravity is moving upward here. Value structurally flows to the top. Creating economic intent down at the orchestration layer, that's becoming abundant. But trusted execution of that intent up at layer 5, that remains highly, highly scarce. And that brings us to the whole thesis of constraint migration. Historically, in the past AI cycle, the main binding constraint was stuck down at layer 2, energy and compute. Whoever had the chips and the power completely held the cards. But as compute scales out and naturally gets cheaper, that bottleneck migrates upward. The new scarcities, the exact places where capital allocation and investment value are going to concentrate next, are trust, permissions, identity, and settlement finality, all the way up at layer 5. Let's just contrast the legacy world with where we're heading. Human-centric commerce is basically defined by manual approvals and friction. We're talking business days, middlemen, and human attention spans. But in machine-mediated commerce, those constraints migrate directly inside the infrastructure itself. So instead of waiting around for a manager's sign-off, we're relying on policy engines that enforce limits in milliseconds, continuous auditability, and authorized machine identity. Let's dive into section 3, programmable delegated authority. So how do we actually grant this authority securely in the real world? Well, a user grants scoped authority. The agent then receives strictly constrained permissions. And this is crucial. It gets absolutely zero access to your raw credentials. Instead, it uses one-time tokens or scoped access to ping an API or a merchant system. Then an authorization layer checks that specific request against risk policies before a payment rail actually settles it. And sitting over the whole thing is a governance layer that logs everything, maintaining the power to just instantly pull the plug and revoke access. The agent acts, sure, but only within a tightly bounded, heavily monitored sandbox. Which leads us to a pretty massive commercial signal. Stripe's recent launch of their Link wallet for agents, that isn't just a shiny checkout button for AI. It's a fundamental architectural shift. They're issuing constrained transactional permissions, things like one-time use cards, merchant restrictions, revocable policies. They are effectively acting as the control plane for machine intent. Stripe is building the exact trusted infrastructure that agent-mediated commerce desperately needs to function. Okay, section 4, the incumbent structural advantage. Now, I know this might sound a little counterintuitive to those expecting AI to just totally obliterate traditional finance, but think back to layer 5. Think about the subcomponents there: settlement, identity, compliance, governance. To operate at that level, you need decades of accumulated trust. You need deep regulatory compliance relationships across multiple global jurisdictions, and you need established liability frameworks. Machine commerce ultimately has to operate within legal systems designed for humans. And guess what? Regulated incumbents already hold the keys to that exact castle. So the structural moat here is incredibly clear. New entrants and AI startups, they're absolutely going to fight tooth and nail at the application and orchestration layers. They totally have the edge in intelligence and workflow automation. But down at the settlement, identity, and compliance layers, that's where your incumbent banks, card networks, and infrastructure firms are sitting comfortably. Their advantage in regulatory engagement and liability allocation is a moat that takes literally decades to build. It's almost impossible for a brand new startup to just replicate that overnight. Moving to Section 5, Stablecoins and API Commerce. Let's look at the connective tissue holding this new high-frequency economy together. Because machines, unlike humans, do not care about bankers' hours. They optimize strictly for latency, availability, and settlement certainty, which completely alters the underlying economics of a transaction. Enterprise systems are actively turning into API-first machine marketplaces designed entirely for programmatic consumption. Machines are transacting in these continuous loops, totally bypassing human batch processing, and stablecoins are emerging as the perfect infrastructure for this. They act as this highly programmable, borderless, low-friction, machine-native money. When you look at the entire end-to-end flow here, going all the way from intent to settlement, you really have to pay attention to that governance layer at the bottom. Because when you have machines fragmenting decisions and transacting millions of times in continuous, endless cycles, transaction density just scales exponentially. And what that means is the governance layer, all the identity verification, the compliance monitoring, the audit logs, that becomes an immediate, massive scaling bottleneck. Systems that were built for human transaction volumes, they are simply going to break under the sheer density of continuous programmatic verification. Section 6, the emerging attack surface. Now, all this transaction density and autonomy, it creates an entirely new risk surface. The Bankr Exploit from May 2026 is a perfect, if pretty alarming, example. Here's how it went down. Step 1, you have an AI crypto assistant named Bank operating normally on the Base blockchain. Step 2, an attacker sends the agent a message on X, hiding malicious instructions encoded in literal Morse code. Step 3, the AI decodes the message, totally fails to recognize it as a threat, and just treats it as a valid user command, eventually elevating its own privileges after receiving a specific NFT. Step 4, the agent executes a completely unauthorized on-chain transfer. The systemic vulnerability here becomes glaringly obvious. Frameworks like OpenClaw often grant these autonomous agents really broad access to local terminals or web browsers. And notice what actually happened in this exploit architecture. The attacker didn't hack the blockchain. They didn't hack the settlement rails. They literally manipulated the machine's interpretation layer. This is a fundamentally new threat model, folks. The AI's underlying logic has become the new economic attack surface. And the liability risk tied to that is just massive. In this specific exploit, roughly 3 billion DRB tokens, worth about $175,000 at the time, were stolen in an absolute instant. Now, while the funds were eventually returned because of immense community pressure, the incident proves the larger point. If machines hold delegated financial authority without bulletproof runtime monitoring, extremely strict policy enforcement, and rock-solid input validation, attackers are just going to exploit the AI's logic. They'll completely bypass our traditional financial security architecture. So let's tie this all together and summarize our macro thesis. The infrastructure transition from energy and compute over to trust and liability is actively reorganizing the global economic system. The absolute highest value layer of the stack isn't the AI agent itself. It's the identity, authorization, and governance frameworks that bound its actions. That right there is exactly where the deepest structural moats are being dug today. And I want to leave you with this final, highly provocative question. As economic gravity decisively shifts toward trusted execution, which institutions are ultimately going to control the governance bottleneck of the global machine economy? Is it going to be the nimble AI pioneers or the legacy banking incumbents who already hold the keys to identity and compliance? It is a macroeconomic shift with truly massive geopolitical and institutional stakes.